Welcome to the CLS Market Review for the week of July 29th, 2013. I'm Matt Harwell. Last week, stock markets closed near the levels where they started the week, despite numerous corporations announcing their second quarter earnings. Through Thursday, aggregated earnings for the 240 S&P 500 companies reporting results were up 4.1%, and revenue rose 3.8%. This week offers an interesting set of economic and policy indicators, in addition to more earnings announcements. Second quarter GDP and July non-farm payroll data will be released. The Federal Reserve is also meeting and may provide further guidance regarding the possible reduction of its bond buying program. In our update for the week of July 17th, we shared some perspective on the nervousness in the market, analyzed why the small stock market decline that started May 21st was causing concern, and looked at which segments were leading the market lower. Here now to provide a follow-up on that report is my favorite Chief Investment Strategist, Scott Kuby. Scott.
Thanks, Matt. The main message of that report was to emphasize long-term investing and show how many of the events were performing in line with CLS's expectations. The following week, the iShares Core S&P 500 ETF fell an additional 2%, raising the level of emotional concern. After the additional down week, market sentiment took a sharp positive turn. Beginning June 21st, the S&P 500 reeled off 4 consecutive winning weeks before falling minimally last week. We thought it would be valuable to share our research on how the recovery impacted some of the key market segments. Ultimately, the iShares Core S&P 500 ETF fell 4.26% during the month-long decline. Since then, it has rallied 6.39%. eclipsing its losses by over 2%. During the rally, value stocks have maintained a slight edge on growth stocks, and small cap stocks, represented by the iShares Russell 2000 Index, have performed particularly well. During the decline, they fell less than large caps, but have rallied more over the last 5 weeks. International markets have outpaced domestic markets during the rally, with Europe leading the way. The returns of economic sectors show even wider variation. During the decline, telecommunications and utilities led the market lower. Telecommunications stocks have staged a very strong rally, rising considerably more than they decline. Utilities have also rallied and are now higher than they were when the broader stock market started to decline. Financial stocks and consumer services have been strong net performers during the decline and rally. Bonds have also staged a recovery, but it is much smaller than the decline, supporting CLS's decision to underweight the most interest rate sensitive bonds. So what does CLS focus on after a rally like this one? First, we maintain reasonable expectations. The market has rallied a fair amount, but rallies stabilize and slow down, just like declines do. Even though markets can continue to increase, the pace of the last 5 weeks is not sustainable. Second, it is important to look at the fundamentals. We focus on earnings and sales growth and pay attention to the modest economic recovery in the United States and the ongoing concerns about Europe and Asia. We expect markets to remain volatile. How should you react to the recent rally? First, don't start increasing your risk just because the market has increased. Second, when the market declines, as it surely will at some point, don't forget to focus on the long term. We usually stress this message during downturns, but it is really an important message all the time. Finally, it is crucial to remember that markets sometimes overreact. During a decline, markets tend to punish all sectors with limited discrimination. Just because a sector gets hit hard doesn't mean it can't rally back quickly, as investors look for opportunities. In the end, a mixture of patience and prudence is usually rewarded.
Thank you, Scott. For those of you who have not yet had an opportunity to watch our market review for the second quarter of 2013, it's not to be missed. Seriously, it's good. That concludes our update for the final week of July, and we hope to see you back next Tuesday. Have a great week.